Value investing is an investment strategy that encourages buying stocks at a discount to its intrinsic value. Value investors usually concentrate on stocks that are selling at a price that are quite below what they should be selling at. And so I want to consider 10 benefits of value investing. Number one, potential for high returns. For the fact that value investors tend to buy stocks at a discount at a price that is quite below what a given stock should be selling for, that particular strategy, that particular approach, that method will guarantee higher returns in the future, because when the stocks eventually appreciates as is expected to, then the investor stands to gain as a result. And I must emphasize the fact that when it comes to investing, the price at which you buy a stock is very, very important. In fact, more important than the price at which you are selling it. If you buy a stock at a sufficiently lower price, you are going to make a larger percentage profit when you come to sell the stocks. And so the entry point is very, very important. And value investing guarantees an investor buying a stock at a discount to its intrinsic value, buying a stock that is cheaper compared to other companies in the market. That would invariably guarantee a higher return when the stock eventually appreciates. Number two, margin of safety. Margin of safety essentially means that you are buying these stocks at a price that is lower than its intrinsic value. And so, because you are buying it very cheap, you are guaranteeing a kind of safety. You are incorporating a kind of margin of safety. An example is buying a stock that could be selling for $1 at 50 cents. So that discount you've been able to buy the stock at, that discount of about 50 cents is what is considered your margin of safety. In other words, your downside is kind of protected. When the stock probably, tends to go down, it will not go down too much. And of course, you have a bigger room for appreciation when the stocks appreciates. And so value investing incorporates margin of safety. This margin of safety is significant in the sense that, human beings are prone to error. We are prone to error in judgment. Should in case there was a mistake in buying the stock in the first instance, because there is a significant margin of safety, the investor will not lose much in case the stock goes down, while making provision for a bigger room for the eventual appreciation of the stocks in future. Number three, lower risk. Value investors tend to concentrate on stocks that have very strong fundamentals and stable financials. These particular stocks do provide, a lower level of risk, because whenever the market goes down, stocks that possess these characteristics, that have strong balance sheet, stable financials, and lower debt, these kind of stocks do not fluctuate widely compared to other stocks in the market. And even if the entire market tends to take a downward trend, stocks in this category do not decline that much. Their price do not decline that much. And so, with this particular strategy, in mind, you tend to discover that your risk is lowered significantly. Number four, intrinsic value focus. Value investors tend to focus on the intrinsic value of a stock. They focus on the stock's fundamentals. They focus on the financials of a company. They don't focus on a company's short-term gain or short-term appreciation. No, like what growth investors tend to focus on. A typical value investor will focus on the company fundamentals and make sure that he buys at a price that is lower than what the company should be selling for. Usually, companies do sell at a lower price for one reason or the other. Very strong companies can be trading at a price that is considered undervalued, and so typical value investors tend to focus on the intrinsic value of these stocks rather than on the stock's short-term growth potentials. Number 5, dividend income. Uh, Value stocks, as we all understand, tend to pay dividends. They have a decent dividend payout ratio. They pay dividend regularly. And so when you invest in value stocks, you have that advantage of not only benefiting from its capital growth or appreciation, you equally benefit from that steady income, stream of income value stocks provides, year in, year out, as the case may be. Number 6, long-term growth. Value investors are known to possess long-term growth. Over a long time horizon, value stocks tend to grow, as the fundamentals grow accordingly, as they are making profits, as they're recording higher earning per share year in, year out. You discover that these value stocks, will grow in accordance to the growth in its earnings. And so value stocks guarantee you long-term growth in the long run. Number 7, market inefficiencies. The market actually is efficient over the long run. Over a long time basis, the market is efficient, as is advocated by the efficient market theory. But on a short-term basis, the market is governed not by reason or logic. The market is governed by emotions of greed and the emotion of fear. So on a long-term basis, on a short-term basis, the market is inefficient because you discover company with very strong fundamentals selling at a very cheap price. You begin to ask yourself why. It's essentially because investors are sentimental at times. And so value investing will give you that guarantee, give you that particular advantage of buying these stocks at a cheaper rate because of the short-term inefficiency of the market. So very strong companies could be selling at a cheaper rate, and as a value investor, you tend to benefit when you buy these stocks at these low prices because of the inherent inefficiencies of the market in the short term. Number 8, reduce exposure to market volatility. Reduce exposure to market volatility. The fact that value stocks are very strong fundamentally, they are very strong when it comes to their balance sheets value. They are very strong in terms of cash flow, and they're equally very strong when it comes to key statistical metrics. You discover that when the market is going on a downtrend, when the market is fluctuating, when the market is volatile, you will then realize that value stocks tend to maintain a decent level of stability. They don't gyrate as much as the market does. They don't fluctuate as much as the market does because their fundamentals are essentially very, very strong, in relation to other companies in the market. And so as a value investor, you are not fully exposed to the inherent fluctuation that occurs in the market as a result of market sentiments and the economic environment. Please, I would like you to subscribe to this channel, give me a thumbs up, and ring the notification bell. It will go a long way in helping me to bring, contents of this nature to you in due course. Number 9, historical success. Historical success. Value investing is known to be a very successful strategy, historically. Investors like Warren Buffett, they apply this particular approach, and that is why today he is considered the most successful value investor and is the richest investor in the planet. And so he adopts this particular strategy. Historically speaking, this investment approach have beaten growth investing. The statistics are there for you to verify if you care to research it. And so it guarantees you success in the long run, because historically, value stocks are known to be done very, very well in time past. Then lastly, number 10, disciplined approach. Value investing incorporates discipline, because value investors take their time to research our stocks, critically. They research these stocks, seriously, to make sure that they invest in companies that are very strong presently and that are going to do well in the future, that have, an opportunity, that have a chance, that have that particular growth prospect in them. And so the discipline involved in value investing is a benefit that every investor could adopt. And as you adopt a discipline approach, and as you adopt the strategy that involves critical stock analysis and research, then you are going to do well in the future. You will obtain outsized return, in the future, because of this particular approach. It's an approach I would advise we adopt, because the evidence portrays the fact that this particular approach is a strategy everyone should incorporate in his investment journey.